Hello and welcome, What the Finance is, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of finance, investing, and markets. On today's podcast, I'm happy to welcome John Williams, who's the founder of Shadowstats, which is a website that calculates the actual inflation rates that we're experiencing, which is, I think, more important than ever. So, John, thanks for joining the podcast today.
Anthony, thank you so much for having me.
You're welcome. So, I guess my first question is, what is wrong with our current measurement of inflation?
Well, the original inflation measure, or at least as it was back in the early 1980s, as it was estimated, worked out pretty well. The problem was, and in fact, it was just about 42 years ago, coming into, say, 1980, you had a very high rate of consumer price index, up around 12% year over year. And that worked its way into the cost of living adjustment for Social Security. The problem for the Congress was that high cost the next year for Social Security payments, and took a dent out of the budget, or increased the budget deficit. And what they started to consider, and in fact, what they did within the next year or so, was to recalculate, reformulate the consumer price index to reduce it, so that it would give you a lower cost of living adjustment for purposes of calculating the CPI for cost of living adjustments on Social Security. The first big change they made was in the area of housing. Consider that you have your housing costs with your heating and taxes, maintenance, whatever. The government, instead of breaking it all out, decided they'd translate that into what they call a consumer's equivalent rent, a homeowner's equivalent rent. What you would pay yourself to rent your house from yourself. And then that was the measure. And then the actual inflation number was, as the government would estimate it, how much you would increase the rent on the house to yourself month to month, which was nonsense. I mean, just the numbers were heavily gimmicked, and it knocked, at the time, I think it knocked about 1.5 percentage points off the entire aggregate CPI index. They made other changes over time. Another component, it helps to understand a little bit what was behind the concept here of the consumer price index. As they defined the CPI, abbreviation for the consumer price index, was a measure of the cost of living of maintaining a constant standard of living. Okay, that sounds fair enough, and that's what people bought when they said, okay, yep, I'll go along with that, and I'll take that kind of an adjustment on my Social Security payment. Well, they didn't maintain the constant standard of living concept too long. As Alan Greenspan later argued it, if steak gets too expensive, people will buy more chicken. And that's true. But that's not maintaining a constant standard of living as far as I'm concerned, and as far as most people are concerned. So they started putting in substitution biases, variety of things that knocked, at this point in time, aggregate almost 8 percentage points off what the headline CPI would have been. And that's, I took offense at it. It was not the deal that the government had made with the American people, and I published economic statistics, and I wanted people to have as good a measure of what was happening as possible. So the government is open about what they did. They estimated how much it would change the CPI when they made those changes. So I just reverse engineered that. And in terms of where things would stand today, and this is based on the headline CPI, and this is pretty high. In fact, it's higher. It's the highest. We've had a streak of high year-over-year inflation the last several months, the peak so far, and it's going to go higher from where it is now. was 9.1% back in June. That's the government's number. And that's the highest since back before when they changed the CPI. If they were reliving the world as it was then, they might look to recalculate the CPI to bring it down again because it's getting too high. I think that resulted in a headline cost of living adjustment around 8.7% or such. But that was just the latest monthly one was 8.2% year over year. My estimate is 16.4%. Had they not made the changes back in starting in 1982, instead of seeing a year over year change of 8.2, you'd be at 16.4 right now. And the cost of living would be up around 17% in terms of its adjustment. But that's not where it is.
Yeah, well, that's amazing to think. So, and I know it's only that they're constantly changing CPI almost every year and how they calculate it. And, I think I heard something where it used to be that there was like champagne in this basket and now they change it to Prosecco, and there's these like Oreos, and then the weight of the Oreos decreases. So even though the price is the same, it's actually decreasing. And as you mentioned there, the quality of life, which is really the main issue.
Yes, indeed it is. And one thing I found of interest, though, is that the precious metals, if you look at gold, for example, it actually tends to move with the actual CPI, not the gimmick CPI. I have my index that, again, estimates the way it used to be. One thing I did was I set my index the same as the government's index prior to 1982. It's the same level. Just after 1982, my index continues going the way the old CPI would have gone, where the government's number goes with the new CPI. And if you look at what happens over time, where the series split, the government CPI sort of flattens out on a relative basis. Mine goes up exponentially. And I plotted that against gold, the price of gold, just the index levels and the price of gold. I didn't even have to change the scale, which shocked me, pure coincidence. But if you look at the headline CPI index, its base year is 1982-84 equals 100. I have the same base year on mine. And if you go back to 1971, when Nixon floated the dollar, back then the CPI averaged about 79, again, against its 100 base. But the price of gold is also at $79 an ounce. So what you find out is you plot them over time, the price of gold starts following my index higher as we get past the government's number. The government's number again goes off like this. The line goes up like this, and the price of gold goes up like that. The relationship's not perfect, but it's still holding up over there. Now, right now, the gold is artificially depressed. It should be over $2,000 an ounce. You've had some very unusual things happening in that circumstance, but over time, give it time, it averages out at the same level as the actual CPI. It's a hedge against inflation, maintains the purchasing power of your assets, and it's been doing that for millennia. You could buy the same amount of you could buy a loaf of bread in ancient Rome for the same amount of gold that you could buy a loaf of bread for in New York today.
Yeah, it's fascinating to think like that. So I guess if we go back to inflation, and then we'll get to gold a little bit later. In terms of what we're experiencing now, is there any other times in history when we've experienced it? Do you have to go back to the 80s, or what's your thoughts on that?
Well, what's happening today is an unusual circumstance. What's driving the inflation is basically money supply. The Fed panicked and flooded the system with liquidity, and that's the primary factor behind it. You have some supply distortions with the pandemic. and I mean, there's some things like that. But the primary thing is inflation. And right now, if you look at that headline inflation and gold, again, that's the gold is the what protects you against the inflation. Well, what I'm suggesting is that if you go back before 1982, you have the real inflation rate, and you'll find that that is a pretty good. You plot it over time. It goes back fairly well as far back as you have numbers that are meaningful. I mean, you can go back a century with it, and you'll still see that. You'll see a pretty close relationship. Now, the extreme inflation that we're seeing now is somewhat different, but again, gold and inflation tend to move hand in hand.
Yeah,
So maybe not day to day, but average it out over a year or such. Take it as a long-term hedge. I mean, you may have a period of time. I mean, if you look at my numbers against gold, there's a year where perhaps you see gold go up like that, and my number's like this, or my number goes up like that, and gold's going like that. But watch them over the a year or two, and you'll find that they stay pretty much together.
Yeah, it's interesting. So, I'm going to ask another question about history. If we think about 2010 to 2020, that was a period where central banks were struggling to find inflation as measured by their CPI. Was it as bad as they were measuring, or were we actually experiencing real inflation according to that 1980s measure?
As far as I'm concerned, the 1980s measure was a pretty good measure. It seemed to, it was as honest as I've seen the government put out. It's when they went beyond that measure, when they went to adjust it, and that was in 1982. So I mean, as it stood before 1982, I think it was a fair balance of inflation. And after 1982, they made changes. Had they defined it like that initially, and you'd measured that way over time, then that would have been the measure. But they changed the way they measured it, and significantly. And then they continued to change the measure. And they changed the measure deliberately to understate it for the purpose of cutting back on cost of living adjustments for Social Security. They were very open about that, and I think that's wrong.
Yeah, I agree, definitely. So, you mentioned how you're measuring the real CPI as we experienced back then. Do you have any sort of indicators that you watch to potentially predict what that real CPI might be in the next 6 months or a year? Because I guess a lot of people are thinking we could enter a recession, and that could potentially be deflationary for the economy. So I'm not sure if you have any opinions on that matter.
Well, it's the same things that would affect the current headline CPI will affect the old traditional CPI as well. It's just at what level of magnitude. And right now, the primary problem is not the economy, contrary to what the Fed says. The problem is money supply growth. You go back to when the pandemic hit in February of 2020, March of 2020, the Fed just floods the system with liquidity, pumps up the money supply. Growth that it hasn't been seen before. Right now, well, they started playing around with their numbers as soon as they did that. And I've looked at the money supply over time. The money supply is a pretty good predictor of inflation. It actually drives inflation. As they started to report their headline money supply after they'd started to liquefy the system, you started to see a big jump in what was then called M1. This is the narrowest measure of the money supply, which included basically currency in circulation and demand deposits, checking accounts. That was soaring. And they're reporting it weekly. So you're seeing these weekly numbers. They didn't like that because it made people nervous about what was going to be happening to inflation. So they, at least that's the way I read it, that they didn't state that as the reason for what they did, but what they did almost immediately was they redefined the money supply and delayed the weekly reporting and came out with later monthly reports that are still lagged. I mean, we're getting tomorrow, we'll be getting the money supply numbers for September, and here we are at the end of October. So it's delayed. You don't get to see what they reported, but the money supply, the M1, which is a narrow liquid part, that's the important part from the standpoint of inflation, because when people go out to buy things, they go to the grocery store, want to get some new clothes or whatever. Usually they're using their cash or checking account. They're not liquidating long-term time deposits to do that. So what they did was they redefined M1 and added in savings accounts, which previously had just been the bulk of money supply. M2, which is now the aggregate money supply number, had been for a while before. But it's a little less liquid. They said, oh, so we've changed things in terms of reserve requirements, so it's just as liquid now. But the average guy doesn't look at it that way. They're still spending money in cash and out of their checking accounts. The most liquid measure, headline measure of the money supply used to be M1. And that's basically cash in circulation and checking accounts. Then you had savings accounts that were added on that. That gave you the broad M2. They used to have an M3 measure, which I still follow, which has even broader, deeper accounts. But M2 right now is the headline money supply. And as this whole crisis started, M1, which is the most liquid measure, I now call it basic M1. My definition simply is the cash and the checking accounts. It was, and there was 18% of M2. And now after redefinitions, it's a definition that's up around 88% of M2. So you don't see the flight to liquidity that's taken place. Extraordinary flight to liquidity, greatest flight to liquidity that we've seen in 42 years. And what you'd see is if you look at the money supply numbers since the onset of the crisis, M2, the broadest measure, has been spiked with the Fed easings and such, and it's equivalent. The amount that M2 is going up by is about the equivalent of 6 years of stimulus instead of 2. But the old M1 is 23 years of stimulus instead of 2, and that's because the cash is flowing there. People have been buying it out of their checking accounts, their cash, and overall it's up 100 against its pre-pandemic peak, which is the way I measure it, because of the big ballooning that you had after the pandemic started. It's up 123% from where it was before. We've never had anything like that before. That's what's driving the inflation. It's that surge in the money supply, particularly the most liquid end, the cash and the demand deposits, the checking accounts. Now the Fed is tapering, cutting back, trying to cut things back, but the old narrow M1 still is growing, and M2 is basically flat. You haven't seen any cutback there. And again, all the surge went in that first year. Extraordinary growth. I mean, again, depending on the measure, 6 to 23 years or such worth of stimulus. Until they cut back on the money supply, you're not going to pull back on the inflation. Now, if you listen to the Fed, they're addressing the inflation problem by raising interest rates. And if you had a booming economy, that might help. Over a booming economy, overheating economy, as the Fed chairman likes to describe it, that will drive prices higher. That's one way that you get inflation. And so that if you raise interest rates, you want to kill an economy, raise interest rates. That'll slow the economy. And if it's an overheating economy, that'll help to slow the inflation. But that's not the problem with the inflation here. The inflation problem here is the money supply growth. The Fed's not cutting that. So right now they're still keeping the inflation, the money supply at extraordinary levels that is fueling the inflation, and they're raising interest rates to kill a non-overheating economy. The economy is in terrible shape. So we're heading into a recession, and we've still got bad inflation, and it's not going to get much better. In fact, I think it's going to get worse the next 6 months to a year.
Yeah, it's interesting. So is there how would the Fed reduce M1? I guess is that just by stopping QE and increasing the rate of QT, or is there a way they can do that?
Well, it's tight. They take cash out instead of put cash in, and they're not doing that. What they're doing is raising interest rates, and that does not reduce the money supply.
Yeah, it's scary to think. So you mentioned before how gold is quite correlative to, I guess, the real inflation as they measured in 1980s. Are there any other commodities or even other assets that you see have a positive relationship like that? So maybe silver or anything else?
Well, hard assets, gold and silver, are traditional hedges there. And if you're looking to hedge against inflation, that would be what I would look at. And I would look at physical holding of the gold and silver. I wouldn't put it away in a safe deposit box per se. It may be dangerous to say, but I think we've got a very dangerous time ahead of us here, where you could have runaway inflation. It effectively gets out of control. I think the economy is going to get a lot weaker. And if you run into a real inflation problem, something that you start to see more than 8-9% inflation, get up to 20%, 30%, as they reported. The flight to gold, I would expect, would intensify, irrespective of whatever's happening to the price of gold right now, where it's so low against where it's been in recent history. I don't believe that is a market fundamental. Very suspect as to how the gold prices are holding down that low in this current circumstance. I think someone's playing with it, but I can't show that. It is if you have if gold becomes the flight to quality asset, which it is. It's the type of thing that governments in the past have banned, have confiscated. They've done all sorts of things, and that's why I'd be inclined to maintain personal ownership of it. That's just my own personal preference. I don't trust the government here.
Yeah, it's concerning thing what could happen. So, John, thank you so much for your time. I've really appreciated the interview. So I guess my last question is, what is one message you'd like people to take away from our conversation?
Go on your gut instincts. If you think the economy is getting bad, you're probably right. If you think inflation is worse than the government's reporting, probably right. It is there are ways of protecting yourself, and the precious metals in particular are areas that will do it. Again, real assets, real estate is an inflation hedge. But I have no problems with that, except you may have periods of illiquidity. And if you get into social unrest, which could happen in an extraordinary circumstance, I'm not predicting it, but these are extraordinary times that are ahead of us. It's not portable. So I look at holding physical gold and silver, and in the form of coins that people recognize, not great numismatic value, but bags of old silver or standard mint coins, uh, for the reason that if you're using it in a barter circumstance, let's say we end up in a hyperinflation, and I think that is a real risk. You might want to take a bag of silver coins to the supermarket to get your food or to trade with a farmer. And if you have something that's recognizable as a coin, people will recognize if that's silver or gold, as opposed to saying, "Yeah, I want to assay that before I trade with you." That's just a quick aside there, but I would look at the precious metals as the store of wealth here. Preserve your purchasing power over time, and
Yeah,
use common
definitely.
sense.
Sorry, yeah, it definitely seems like that's the way to go. So, yep, John, thank you so much for your time. Yeah, I'm not sure if you want to tell the audience maybe where they can find more of your work, Shadowstats. I know you released a newsletter as well, so I'm not sure if you want to talk about that a bit.
My website is shadowstats.com. I put out a newsletter. I actually have a new commentary coming out in the next week or so. I think people will find of interest. I also have on my homepage what's called a daily update section. That's open to the public. You just read down it and look at the different areas that you have interest in. Whenever there are new numbers, it's updated there. And if you're a subscriber, you'll get an email with those updates and graphs.
Yeah, perfect. I'll put that all in the description below. But yeah, John, thanks so much for your time.
You're most welcome. Thanks for having me on your show.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.